Hello and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. The last trading day of the week ends solidly for investors with the Nasdaq and S&P 500 rising. We'll have more on the markets and look ahead to next week. The economic ripple from tariffs having an impact on how and where goods are shipped and dispersed. We'll take a deep dive into the state of supply chains. And are we seeing an appetite for spending? We'll take a close look at where consumers are opening their wallets amid tariff turmoil and market uncertainty. Well, the S&P 500 gaining for a fourth straight day, its longest winning streak since January. Yahoo Finance's Josh Schaefer joining us now with the trading day takeaways. Hey, Josh.
Hey, Julie. Yeah, I want to start with that S&P 500 run that we saw. So 4 straight up days, first time we've seen it since January, and it was largely tech leading that. So for the week, we're going to zoom out to a 5-day here. The S&P 500 rose over 4.5%. Then you take a look at the Nasdaq, which does have more tech companies within it, up over 6%. And then I want to look at our heat map and sort of look at what was going on with some of large cap tech. So again, that's your sector action. You can see XLK, information tech, rising 8%. But what was interesting to me, I mean, you got Tesla up 18%. Bad earnings report, generally speaking, but CEO Elon Musk likely coming back, but maybe a potential tailwind with some full self-driving news there. You look at Nvidia up 9%, Amazon up 9%, Meta. But what I think is perhaps most interesting moving forward when we look at this screen is when I flip it to a year to date, right? So we got a lot of green on our screen, a lot of red.
Anymore.
Yeah, so we haven't made, we've made progress, right? But I think it's important to remember how far away we still are from sort of where we entered the year, right? And when I look at this screen, I sort of wonder, all right, you have earnings from Amazon next week, earnings from Apple, earnings from Microsoft, earnings from Meta. What are we gonna hear that maybe gives investors a little bit more confidence other than just a bounce off the bottom that makes this a little bit more sustainable?
Yeah, and then also one of the other things we got today was the revised consumer sentiment numbers. Yes. We've also heard from a lot of, not so much consumer discretionary companies yet, retail comes later, but we've been hearing about the consumer staples companies and the tariff pressures they're gonna be facing.
Yes,
too.
And so we had that revised consumer sentiment number, Julie, and it was bad.
Yeah.
So it came up slightly. So the difference in this consumer sentiment number came after Trump announced the 90-day pause, right? So you saw a little bit of an uptick, but generally speaking, you're at one of the lowest levels on record going back to 1980, and there's kind of no other way to cut that. It's very pessimistic out there. And so the question has been, and I've been asking economists this week, well, when does the quote unquote survey soft data lead to hard data deterioration? So Goldman Sachs did some interesting research on this. Couple different lines here. What you're looking at, the blue line, will basically call that the consumer sentiment that we were talking about. So that normally dips down first, right? And you see this big dip down. What's interesting here is the yellow line.
So this is like the average trajectory.
This is the average trajectory for an event-driven recession.
Ah, okay, so pre-recession, okay.
And event-driven recession would be the oil shock in the 1970s, or perhaps Paul Volcker's interest rate increases in the 1980s, right? Those were the sort of events they're looking at, so tariffs, event-driven. What's interesting is you see hard data actually pick up in the first 20 days. You've seen that over the last month with some of the data from March, right? Retail sales were strong in March. You had goods orders were strong in March. It doesn't actually tick down for about 2 months. And so when we flip to, they're tracking it currently, it's basically tracking what normally tracks. And so Goldman is essentially arguing perhaps early to mid-summer, maybe June, July, you start to get a real sense of, okay, how much are we actually slowing when that data comes in?
And yet the Fed is expected to start cutting in June, maybe.
I think that debate's going to be going on for a little while, right? Leading into that meeting.
Interesting.
A final chart that I brought with us today, Julie. So this is sort of looking at the tariff confusion in earnings. So Deutsche Bank had an interesting chart this week. They lowered their S&P 500 target from 7,000 to 6,100. What we're looking at here is what cuts down their EPS forecast.
I love it when they do this.
They highlighted nine.
You and I both love this.
9 different things, right?
Yeah.
So I think lower volume growth, what they're really talking about here, that's recession risk, right? So you're going to get potentially lower sales. Then you look at basically $10 between China tariffs, between exports and imports. And then I have to flip to a second slide because there's so many of them. But persistent uncertainty also gets a big one.
Foreign boycott is an interesting one.
Boycott.
They're taking $3 off for that.
And what my takeaway was from this, again, look, we're looking at 9 different headwinds that bring you from 282 to 240. No wonder why the market's been so chaotic. There's 9 legitimate reasons that a strategist is looking at to weigh on earnings. Each one of these could change tomorrow.
And each one of those could be, if you're talking about $3, could it be $1? Could it be $2? Could it be $5?
Right. And that's with 9 different things, right?
Yeah.
So no wonder why the market is sort of doing this. And I think that gives us moving forward, until we actually get clarity on what policy is, we're probably living in a world where it looks a little chaotic.
Yeah, feels that way. Thanks, Josh. Appreciate it. Stick around. We got more Asking for a Trend still to come. Supply chains in tariff limbo as companies navigate President Trump's trade uncertainty. Trump recently telling reporters he will not drop tariffs on China unless, quote, they give us something in return. The president also said another tariff pause is unlikely. For more on the potential fallout ahead for businesses, let's get to Flexport founder and CEO Ryan Peterson. Ryan, it's always good to catch up with you, especially at a time like this. Now, it's also interesting that both the president and Treasury Secretary Scott Bessent have acknowledged that this is almost an embargo on goods from China, or would result in such. Is that effectively what we're seeing? I know you watch all of the container ship traffic very carefully. What are you seeing right now?
Yeah, great. Thanks. I mean, we don't just watch the traffic. Those are our containers that are moving on there for our customers. So yeah, we see across the industry about a 60% decline in ocean freight bookings from China to the US. Now, remember that a booking gets placed and then it doesn't actually arrive and get loaded on a ship for about 2 weeks. And then it takes 3 weeks to cross the ocean. So that lag there is going to mean that those container shortages are going to start, or the goods shortages are going to start a few weeks from now once the containers fail to arrive that weren't booked a few weeks ago.
Ryan, it's interesting. We talked to a former retail executive earlier, and he said he does not expect to have a lot of product shortages like we did during COVID. And he said that's because since the tariffs are so concentrated on China, that a lot of the retailers do have other sourcing potential, right, where they can draw from. Now, he's mostly has experience with the apparel industry. I know it goes much broader than that. But are we seeing more start to flow from other places?
You see a little bit of uptick in places like Vietnam, Southeast Asia, India, but we remember we don't know what the tariffs will be in those countries. We had a 90-day pause, and a lot of people are acting like, oh, there's going to be no tariffs on those countries, just the 10%, but we don't know. And the truth is, the United States imports over $400 billion worth of goods that retail from China, and those retail for, call it $1.5 trillion once they're marked up. So I don't know what he's talking about. Of course, there's going to be shortages of goods from China if this lasts.
Well, and I know you're focused really on small businesses in particular as perhaps being the most affected by all of this, right? They might have less flexibility than some of the larger businesses. I mean, what percentage of the goods on the container ships are bound for small businesses, and what's going to be the ripple effect?
I mean, most imports are done by larger companies in the U.S. Small businesses have a harder time shifting manufacturing to other countries because the manufacturers in those countries are looking for big customers, not small jobs. And they're pretty backlogged right now. So it's been harder for small business to find new factories, to find new sources. Big companies are more likely to have what's called a China plus one strategy, where they have multiple factories for the same item. But nonetheless, I mean, big companies import a ton of stuff from these other countries, from China, I mean.
Right, of course.
Apologies.
So what kind of hit are we going to potentially see? I know you've been tweeting a lot about this in terms of what potential hit we're going to see, the effect on small businesses and large businesses.
It all just depends on how long this lasts and whether Trump ends the tariffs, or brings the tariffs back down, I should say. I'm expecting that, he said as recently as yesterday that they would probably bring this back down. We don't know to what level. But if it comes way back down, then, it'll be okay. Companies will rebook those containers and start moving the goods again. If it lasts a few more weeks, certainly a few more months, you're going to start to see shortages. You're going to start to see bankruptcies, unemployment, and really just a large-scale recession like we haven't seen in many, many years.
And what about those empty shelves, Ryan? What kinds of goods do you expect there to be that are not going to be coming in to the same extent? When are we going to start to see those not appearing here?
I would expect to see. Well, again, it just depends. I mean, there may be there's a lot of inventory in stock. So as long as these tariffs get relieved soon, we probably won't see empty shelves. But if they don't, you'll see a whole range of things: home goods, things you buy for your house, furniture. A lot of apparel is still made in China. So those are probably the biggest categories. Electronics mostly got exempted.
Right.
Yeah, it'll be a broad range of categories.
Ryan, great to see you. Have a good weekend.
Yeah, thank you.
Stick around. We're asking for a trend still to come. Restaurants among those feeling the tension from tariffs. Traffic trends from Placer AI showing declines in quick service restaurants by 1.6% in the first quarter. For more, we're bringing in RJ Hodeby, head of analytical research at Placer AI. Always great to see you, RJ. So I'm curious, when we talk about these being sort of a casualty of tariffs, obviously it's not necessarily a direct impact, but it's sort of the big tariff vibe right now. So where are we seeing the traffic changes being felt most acutely?
It really is broad-based. We're seeing traffic declines pretty much across the board in just about every category in retail. We really started to see at the end of January when we started to see a lot more uncertainty about the macro environment. As more headlines came out about tariffs, we really started to see those year-over-year declines. In February, once we got to the end of the month, we did start to see some normalization. We did start to see a little bit of pull forward in some of the categories where you typically see a stock up. So we saw strength out of warehouse clubs. We saw strength out of some of the categories like luxury, electronics, home improvement, categories that, at least initially were thought to be impacted by reciprocal tariffs. Since that has gone away and we've seen the extension on the tariffs, we've seen things go back to down slightly year-over-year negative. But it's been interesting to watch. If nothing else, we know that consumers are very price sensitive, and if they feel like there's going to be price increases, they're going to act on that. That is one of the things that's pretty clear with our data right now.
And yet, what's so interesting here is that the QSR, the fast food visits, fell about 1.6%, but fast casual didn't fall by that much, and they're at a higher price point. Are their customers more sort of price resistant or less economically sensitive here?
Yeah, I think that's effectively what's going on. I mean, with the QSR sector, which does lend itself usually towards the lower to middle income consumer, we've seen that group continue to shift towards value grocery and to some extent convenience stores. That has been two channels that we've seen a definite shift in that consumer. We've also seen some of the players in the space fare better than others, say a Taco Bell or McDonald's more recently with its Minecraft promotion do very well, whereas some of the other chains in the category really haven't been able to lean on value, which was a big driver last summer. Some of the chains like Taco Bell and McDonald's are driving through innovation and at least driving visits that way. The fast casual customer, you're exactly right. That typically is going to be a higher, more affluent consumer, one that's able to take on that $15 price point. But what is interesting about the fast casual space is the winners in this group, so the Chipotle, the Cava, the Sweetgreens. It's really those groups that allow for customization. And so what we're seeing is that if consumers have control over that order, if they're able to customize and get just what they want, they feel like they're getting that value even at a higher price point. So that's one of the things that we've been looking at with our data. And that's even factoring in, obviously Chipotle reported this week, mentioned that we did see some consumer uncertainty weighing on their results. But even that said, on a relative basis, they're outperforming.
What are we seeing on the coffee front, right? We've also seen, by the way, tariffs aside, coffee's prices have been going way up for raw coffee beans for these companies. But, as we go into earnings next week for a company like Starbucks, what are you seeing in trends there and some of its competitors?
Yeah, that's actually the great question is its competitors there. We are seeing some real strength out of the kind of mid-sized regional chains. So that would be your Dutch Bros, that would be groups like Seven Brew and Scooters Coffee. If you look on the year-over-year basis, on a comparable visit basis, they are really what's driving a lot of the strength. Now, some of that's just they're picking the right markets, they're picking high-growth markets, they're picking successful sites in these markets. But it's been a real disruption on really Starbucks and Dunkin' as kind of the two incumbents in the space. Obviously, Brian Nichols got a plan for bringing back the experience and revitalizing the Starbucks experience. But right now, what we're seeing is that there's still a lot of competition, and these smaller kind of upstart chains are really taking a lot of share within the category.
Across food and beverage there, what are you seeing in terms of promotions being offered? And are these companies going to be able to keep up that cadence if some of the food items that are their ingredients are being tariffed?
Yeah, it's a good question, and it really is a catch-22 for a lot of these chains. Admittedly, the larger players in the QSR space generally do have global sourcing options, and so I think they'll be able to offset some of the tariff increases that would go along with it by sourcing from different locations. But that's not everybody. Some of the smaller chains may be limited in terms of the options they have in terms of promotional strategies. It is interesting. We have since really about the fourth quarter last year, certainly value is very front and center in a lot of the promotions, but it seems like we're seeing a shift away more towards innovation, new products, or intellectual properties. So things like a SpongeBob promotion that Wendy's ran, which was very successful, and the Minecraft promotion. So we are seeing a bit of change in strategy, less anchored on price, although that certainly is important, and more on kind of innovation and newness is really what we're seeing a lot of promotions coming out of the QSR space.
RJ, great to see you. Thank you so much.
Thank you.
Here are the earnings we're watching for next week. It's going to be a busy week with 4 of the Magnificent 7 reporting earnings, including Microsoft, Meta, Apple, and Amazon. Let's start with Microsoft. It's reporting third quarter earnings on Wednesday. Analysts expect solid cloud growth in the third quarter, driven by strong bookings and demand for AI services. Next up, Meta, the social media juggernaut, also reporting after the markets close on Wednesday. Analysts see ad pricing pressures ahead for the company, with ad revenue slowing due to Chinese companies like Temu and Shein cutting spend because of rising trade tensions between the U.S. and China. And on to Apple, which is announcing results for the second quarter on Thursday. It has been a tough quarter for the company as it navigates the ever-evolving tariff landscape. Although Apple did receive some relief from President Trump's exclusion of smartphones, computers, and other electronics, analysts are still expecting its supply chain to dominate the earnings call. That's a wrap on today's Asking for a Trend. Be sure to come back on Monday at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great weekend.